Okay, so you're ready to start investing. Awesome. You've probably heard the same advice from everyone, right? Just buy the S&P 500. Sounds super simple. But then you log into your brokerage account, you type it in, and you're hit with this choice, SPY or VOO. And all of a sudden, that simple advice feels, well, not so simple anymore. Don't worry, we're going to clear all that up right now.
This is the big question we're going to answer. And by the end of this, you're not just going to know the difference between them, you'll know exactly which one is the right choice for you and your goals. So let's get into it.
Buying the market is genuinely great advice, especially when you're just starting out. It's this idea that you can own a little piece of all the biggest companies in one go. But this confusion between the ticker symbols, SPY, VOO, it's a really common roadblock, so let's just knock it down.
First off, what are we even talking about? Well, both SPY and VOO are S&P 500 ETFs. Now, ETF stands for Exchange Traded Fund. The easiest way to think about it is like a basket. This particular basket holds tiny pieces of about 500 of the largest, most successful companies in the US. When you buy just one share of the ETF, you're buying the whole basket. It's like instant diversification, a total game changer.
And here's probably the most important thing I can tell you right from the start. Both of these funds are built to do the exact same job. Their only goal is to copy the performance of the S&P 500 index. So listen, there's no major wrong answer here that's going to ruin your life. They're both fantastic tools for getting you invested in the market. So they're both trying to get you to the same place. Before we start picking them apart, let's just appreciate how similar they really are. Think of them as two different car models from competing brands. Both are designed to be a perfect family car. They might have a few different features, but they share a whole lot of the same DNA.
And I mean, this DNA is practically identical. They both track the S&P 500, which means if you look under the hood, their biggest holdings are always going to be those huge names you hear about every day. Your Apples, your Microsofts, your NVIDIAs. They both give you that same big picture exposure to the US economy. And if you pull up a chart of their performance over the last 10 years, you can barely see a sliver of light between them. They move in almost perfect sync. This image here illustrates that perfectly. It's called a style box, and it shows you where a fund invests. And look, as you can see, both SPY and VOO are sitting right there in the exact same box, large cap blend. That's just a fancy way of saying they are fishing in the exact same pond for the exact same big fish. All right, so if they're so similar, why do we even have to choose? Why is this even a conversation? Well, because, as they say, the devil's in the details. And there are three small but really important differences that will help you decide which one makes more sense for you. Let's start with difference number one. And honestly, for most new investors, this is the one that matters most. We're talking about cost. See, every ETF charges a tiny annual fee to manage everything. It's called the expense ratio. And in this category, there is a very, very clear winner. Take a look at this. VOO, which is from Vanguard, has an expense ratio of just 0.03%. It's incredibly cheap. Now look at SPY from State Street. It charges 0.09%. That means you're paying literally 3 times more in fees every single year to own SPY. And I know what you're thinking. Come on, it's a fraction of a percent. What's the big deal? But as this quote points out, that tiny difference gets magnified over time because of the magic of compounding. Think of it like a tiny, slow leak in a tire. You won't notice it at first, but over a long road trip, it makes a huge difference. Those little fees eat away at your returns, year after year after year.
Let's make this real. Let's put a number on it. If you had put 10 grand into VOO back when it launched in 2010, you would have about $923 more in your account today compared to putting that same money in SPY. That's real money. That's a plane ticket, a new phone, or hey, even more money to reinvest. The point is, fees matter a lot. Okay, so that was cost. Difference number two is a little more technical, but stick with me because it has a real-world impact. It's all about how the funds are legally structured. So SPY is the original. It was the first ETF ever, back in 1993. It's built on an older, more rigid structure. The main drawback here is that when companies pay out dividends, SPY has to hold that money as cash for a while before it pays you. And that cash just sitting there, not invested, creates what's called a cash drag. VOO, on the other hand, is the newer model. It uses a modern, more flexible structure that lets it reinvest those dividends immediately. It keeps every single penny of your money working for you all the time.
And that brings us to our third and final key difference. Now, this is the one area where SPY has a huge advantage, but it really only matters for a very specific kind of person. We're talking about liquidity.
Liquidity is just a fancy word for how easy it is to buy or sell something super fast without moving the price. And in this arena, SPY is the undisputed champion. I mean, just look at those numbers. Every single day, over 25 times more money flows through SPY than VOO. This massive volume makes it incredibly easy for big institutions and super active day traders to jump in and out of huge positions in a split second. So we've got our three big differences: cost, structure, and liquidity. Now it's time to put it all together and figure out which of these is for you. And it really all boils down to one simple question. Are you a trader or are you a builder?
This really is the bottom line. If you are a trader, someone who's in and out of the market all the time, using complex things like options, and needing to move millions of dollars instantly, then yes, SPY is your tool. But liquidity is king. But if you're a builder, and let's be honest, this is most of us, especially if you're just starting, you're playing the long game. You're buying and holding, adding a little bit from each paycheck, and letting it grow for decades. For you, VOO is almost always the smarter choice. Its lower cost and more efficient structure are literally designed for wealth builders.
So at the end of the day, this isn't about which ETF is objectively the best. They're both fantastic, high-quality funds. The real question is about picking the right tool for the job you're trying to do. It's about matching the fund to your own personal strategy.
All right, let's wrap this up with the key takeaways. Number 1, SPY is the king for active traders who need that split-second liquidity. Number 2, VOO is the more efficient, cost-effective choice for long-term wealth builders. Number 3, the best choice is all about your own personal goals. And finally, and this is important, you only need one of them. Buying both is like having 2 copies of the same book. It doesn't give you any more diversification. Just pick one and go.
And that's really what it all comes down to. The choice isn't really about the ticker symbols. It's about you. It's about deciding what kind of investor you want to be. So ask yourself that question. Are you here to trade the market's daily wiggles, or are you here to build your future with it, one share at a time? Once you know the answer to that, your choice becomes crystal clear. And if you want to learn even more about starting your investing journey in the US markets, you can find a ton of great resources over at usmarketinvesting.com.